Well, let us get started. So I'd like to say thanks for everybody being here on this Saturday. So I really love these Saturday events. So we're going to dive in today, selling options for income, profits, and hedging. So yeah, again, thank you so much for being here. I love these Saturday events. Markets are closed. We can kind of kick back, be relaxed, not have to stare at the screen and price movement, all that kind of stuff. So it kind of gives us a chance to really, think and concentrate and focus on certain areas. And today we're going to be talking about different option strategies that are having a big sell side component to it. And so, we'll get into that in a few minutes, but just a little background on myself. I started my trading journey back in the 80s on the oil side, and was fortunate to get a job at a company when I was out of college called Coastal Corporation. They actually had a program that would train you to trade at that point in time. We were trading, trade crude or oil products, things like that. So it was a great experience. So I got into that program. They, started off sending me down to one of the refineries they had down in Corpus, Texas. Is a big refinery, and spent about 3 months down there. So it really kind of gave you a grounding experience of, learning how, a tanker of oil would come in and you produce different products out of that crude and stuff, and then ended up in the chartering department of the company, chartering ships and doing the operations, and then finally got on the cargo trading side of things, and sent me out without no time at all. I ended up out in Singapore with the company for about 2 years, trading products and Asian crudes out there. That was just a fantastic experience in Singapore. If you ever get a chance, make sure to check out Singapore. And then was hired mid 80s by a large oil trading company, largest in the world, was Trans World Oil at that time, and Fibro, Mark Rich were the other two big ones. And so we were, in all the different energy sectors, really big. Spent about 17 years with Trans World, and about 16 of those years out in Bermuda, which was the kind of the corporate headquarters. And it ended up running the trading group for 10 years out of Bermuda. So beautiful island, but that's where, really started trading options back in about 1987. We started trading options on crude oil and kind of never looked back. So it's a great way to, define your risk and, create great spreads for great leverage. So just a little background there, and let's get going. So the following webinar presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, trading is a business of probabilities, and to be a successful trader or investor, controlling your risk is really what's going to win the game for you. So by knowing and better understanding how to manage and control that risk, it's going to make a really dramatic and positive difference in your trading or your investing performance. And the best way to really achieve this goal is through the use of options, and more so option spreads. Now, the reason I love, options is because of the unique pricing structure and the capabilities that option spreads will offer you. So you can really control then the probabilities, and the probabilities that can be then tilted more so in your favor. Now, when used correctly, option spreads are going to provide you very good defined trading risk. It's going to help to, lower your capital at risk. And this is going to provide you greater trading returns based on the leverage you get. And then the other really big plus is they're just an unmatched hedging advantage. So options were originally created for hedging, but, and they still are the best way to hedge. So we'll get into that quite a bit, talk about it. Now, step one is to know then how option pricing works. So in order to, understand the pricing of the option or the value of the option, this is going to help you then to understand how to maximize your option trading profit. So first off, it's, pricing the option. Now, when we're trading the option or options, the most important option factor is to understand the concept of time and volatility and how they impact the price of your option. Now, when we look at time, price component, the time value, which we call time value, or the extrinsic value of your option, it's the premium that, a rational investor is going to be willing to pay over the current exercise value, which is your intrinsic value based on the potential that it can increase in value before expiring. Now, the change in this value of the option is going to be based on the time decay, and this can be measured by a Greek we call theta. Now, time decay, it's always going to work against buyers, but it's going to benefit the seller of options. And so this is because option theta values are going to have either what we call a positive or negative characteristic or value. So if you're long a stock option, such as, let's say you go long a call or you long a put, it's going to have a negative theta value. So this is going to basically indicate that it's going to lose value as expiration draws near. So it's a decaying asset. And if you don't get that price movement up or down that you need to offset that theta value, you're going to lose money on those long options. Now, the other side, or flip side of the coin, is that the short options positions are going to have the positive theta value. So that's going to indicate that these positions will actually gain and benefit from time going by, even if the price of the security that you're in doesn't move. So this is where you gain value from selling the option. And then you have the other main pricing component, which is volatility. Now, implied volatility is expressed as a percentage of your stock price, indicating a 1 standard deviation move over the duration of your option cycle. Now, in theory, though, a stock should end up within about a 1 standard deviation move of its original price, or 68.2% of the time during the option cycle. Now, again, this is theoretical, but it's what we're going to use to forecast a security price range and see what it should be, and this should be a big part of the process you use for then selecting the highest probability price targets for any trade that you're looking to take. So the kind of simplistic value of your option comes down to time value times the implied volatility times the intrinsic value of the security. Now, once you understand or know these variables, then you're going to be ready to price out that option and then know what the option premium should be. So here's a really kind of a good illustration of this. So, every Thursday we get a new weekly option series. So on that first day, that first Thursday, we're going to have 100% time value component into that option. So remember, again, the price of your option is going to be based on the time value times the implied volatility times the intrinsic value. That'll give you your premium or the value of your option. So that first day, you've got 100% time. So if I plugged in implied volatility here of 300 and going to leave the values of the security constant. So you can see then your premium would be $300. Now you come back in on a Monday after the weekend, it's still decaying even over that weekend. So you come back in Monday and you've just lost half of the time value of that option. So even if we had a big spike, plugged in 800 here, big spike on implied volatility, you can see the premium of your option only went up to about $400. Now, what if you had just, the implied volatility was 200, then you can see your option premium is just going to be a $100 value. So you can see how this is a big effect on your option price. And at the end of the day, at the end of every series, time is going to go to zero and volatility, implied volatility, go to zero. So when we're selling options or doing option spreads that have a sell side component to the spread, this is what we're taking advantage of. We're taking advantage of selling time, and we're taking advantage of that selling volatility. So this gives us a great advantage for a lot of different things we can do to benefit from this kind of sell side component of an option trade. Now, the second step is the secret to income using options. So it basically comes down to knowing when it's time to sell. So, if you look back over your trades and you dissect and pick apart all your winning trades or losing trades, you'll probably recognize a pretty much key theme is that either you're getting direction right, and the other really big component is you're getting the timing of your entry, right, or the exit. So that gives you that edge. And so it's really comes down to being really helpful when you know when it's time to sell or know when it's time to buy. Now we can actually, trade time, and we can do that by selling time to take advantage of the option time decay or theta. Another way to think of an option, think of it like a coupon that you get at a store. So that coupon is going to have a redemption date, right? So you have to redeem it by a certain expiration date or else it's no longer valid. Well, that's exactly what an option is. An option has a certain life or certain cycle, and option theta does not remain stagnant as well. So at the end of the day, it's going to go to zero. but it's always moving around, either up or down. So it's going to actually increase as expirations draw nearer. That theta, really starts to increase, and also decreases as your options go more in the money or out of the money because the intrinsic value of the option changes dramatically. Now, the big effect of your option theta decay is going to be most pronounced in that final 30 days. That's where it really soars, and that's where that theta really kicks in. So if you look at this kind of time graph, you can really kind of see the illustration of how it affects. Like, let's say we go out 120 to 90 days out. Well, at that point, way out in time, there's very little time decay. So it's very, very small. You can, it has not a big, huge effect on your options that you may buy, like a call or put. But as you get about 30 days out, that's when it really starts to accelerate. And and the great thing is we have weekly options that we can take advantage of for that accelerated time decay and that accelerated volatility starting to collapse. Now, at the end of the cycle, what happens? They both go to zero, right? So you can see it's a full decayed asset that you're working with when you are trading options and when you're buying an option. So the second or third step is trading the probabilities. So this is what I call the market maker's secret. It's what they really don't want you to know. And it's based on, how option pricing works, based on implied volatility and standard deviation and the effect that it has on your option. Now, when you look at broad markets, they're going to have, 1 to 3 kind of week cycles where the trade will be either sideways or in channel. About 70–80% of the time. So when you look at, price action, you'll see a big spike maybe, or a big spike up or down. And then the market price, it cools off. It's trying to regain that, that energy, right? So it kind of goes sideways. So it's based on the sideways kind of price movement that out of the money options or option buyers are going to lose approximately about 70% of the time. Now, the market makers, the professional money that makes the market for the option price, they know these statistics, and they're going to then tend to trade from the sell side. So this is the professional money, and we need to think like a market maker, and it all based on the math of probabilities. Now, the option market they use mathematical market probability statistics to price out the movement of an option into its expiration. So by knowing the probability of your underlying security or stock finishing within a certain price range at expiration is key for then determining then what options you're going to buy or sell and what option strategy to use. Now, these forecasts or statistics that forecast how likely it is your option will fall within a certain option series price range, up or down, is the first place we start. And this forecast is what we refer to as the implied move of your stock or the expected move. Now, this implied move is, based on an estimation of about a plus or minus 1 standard deviation move of that underlying security by its expiration. So I always explain 1 standard deviation is kind of what a normal price movement would be based on the option series that you're trading. Now, when we're selling out of the money options, like 1 standard deviation out, you're going to start out with what we call a theoretical 84% theoretical chance of winning. Okay, so this is kind of based on the option, the mathematics behind it. So if you look here, this is a normal distribution bell curve, right, for data distribution, and this thing is price distribution. So if we're trading at the money, XYZ is trading at $500, and we've got a 1 standard deviation price point to the outside here would be, in this example, 520. So that'd be about 4% up, 4% down, and then 480 on the downside. So that range, that's your 1 standard deviation range. Now, it's this outside point that we can measure. It's basically based on your option delta. So this is going to be about a plus 16 delta. So when you look at a delta for a call delta of 16 or 20, that's showing you that outside 1 standard deviation price point, okay? Or if you're looking at the put side, it's going to have a minus 16 or 20 delta. Now, again, I kind of explain this as your normal move over the course of the option cycle. So let's say there's 10 days in this example to expiration. So over the next 10 days, the market's saying that XYZ, which is trading at that point in time at 500, it could go up to 520 here, 520, or it could go down to 480. So that would be a normal price range or movement, okay? But once you start exceeding that, then it starts to get extreme. And then the chances or the probabilities of hitting those outside points even further up or down become less and less likely, or less probability. So when we look at delta, we can equate that to like shares of stock. So if you have a delta of 1 or 100, that's like you're equivalent to you're owning 100 shares, right? So then if you had a delta of 16, you put that 16, and then what you have left is your 84. So a couple of different ways you can look at it. So then if you were to sell that 520 strike as a short strike here, theoretically, you've got an 84% probability that price will be below 520 at expiration. Or the other way to look at it is you've got about a 20% probability or 16% chance that the price will be at 520 at expiration. And the same goes on the put side, okay? So those are ways that we can measure theoretical probability, using option delta. And then the other thing is what we call straddle cost. Now, here's an example. Here's your option delta and tribe probabilities, and this is the Thinkorswim platform. So you can see here, Apple trading here at about 190, right? So the at the money 190 strike here, you can see the delta is 0.52. So that's basically 50. So there's a 50-50. There's a 50% probability that price will be at 190 or below, or 50% probability of 190 or above. Now, when you start to get way out, go further out the curve to the out of the money, further outside from that at the money strike. Let's say we go to 215 here, you can look over here and see the delta is 0.05. All right, so then you look here, it says that's probability out of the money statistics. So you can see here, then the probability of being out of the money at expiration is 95.61. So that's basically, you can look at that 100 delta plus your 5 delta, and that gives you that probability out of the money. So a couple of ways to look at it. Then if you were to say sell that 215 strike, there's a 85, or there's a, this 95% probability that price will be below 215 at expiration, or there's only about a 5% chance or probability that price will get to that 215. And then you can also see the huge difference in price. So here the 190 strike is like a $6 premium, so that'd be 600. And the 215 though is about, let's call it 30 cents. So that's $30. So you can see the huge difference there between premium, and that's because it's a high risk. There's a low chance that price will get there. So therefore, there's a, you're going to get a big payoff, but there's a lot of risk to that there, because there's a low probability it's going to get there. So then you can see then using these kind of probability analysis becomes very useful tool for then determining price targets to trade against. And it's also very great for setting your hedges. So we can set our hedges based on where the delta is. That's typically the way we'll look at it. So it's based on this kind of math of probabilities. You're going to see that approximately 70%, options bought are going to expire worthless. So based on the probabilities alone, it's a really good idea for all traders or investors also to look at the sell side of your options as well as just buying them. So by adding selling strategies to your trading portfolio, here's a really good hypothetical example of probability. So here's a question that Bill asked: is a probability options closely tied to option delta? So this, I think, will help you see the probabilities here based on option delta. So here's a theoretical. So let's say you're bullish on Tesla, and Tesla is trading at $426. Now, as a beginning option trader, you might be tempted to buy, let's say, calls 14 days from expiration with a strike price of $670 at a cost of 40 cents, which would be $40 per option contract. Now, remember, one option contract is equivalent to 100 shares. So if you spent 40 cents, that's 40 bucks, right? So pretty cheap. Now, why would you look to do that? So when you look at the math, you can do a lot. Now, here's just kind of give you a visual of what things are looking like. So Tesla's trading right about here, 426. Now, what you're going to see in this kind of hypothetical example is, Charlie or whatever, XYZ, he's looking to trade and buy cheap options on Tesla. So he's going to be looking at maybe going out and buying this strike, the 670 strike, which is at $40 per option contract, okay? So we're going to go through this and show you how option delta works and the probabilities of that being a successful trade. Now, if Charlie was to buy 100 shares of Tesla at 426, that's going to cost him $42,600. But for the same $42,600, he could buy 1,065 contracts of the $670 calls. All right, and so that would control 500,000 shares. That's huge, right? So he looks at it and says, okay, if Tesla then was to hit that 670 within the next 14 days of the option cycle, those $670 calls that were bought for 40 cents or $40 per option contract, and if they're trading at $1.40 or $140 per contract, you're going to make $1, per option contract. So that would be over $106,000, right, in 2 weeks. So if he went out and instead of buying 100 shares, he was able to take that same capital, 42,600. He bought those $40 option price contracts. He could buy up to over 1,000 contracts, right? And then if that blew out, and we were saying it's trading 140, he's up 106,500 in 2 weeks. So you look at that at first glance, this is the kind of leverage you get from options, but it's also defined risk if you do the right type of option spreads or strategies. But you don't want to let that glitter fool you, because not losing money, in trading is as important as making money, right? So the problem with short-term out-of-the-money options is that you not only have to be right about the direction the stock moves, but you also have to get right that timing, and that's really critical part of it, the timing. So this is what's going to really ratchet up the degree of difficulty for your profit. So to make a profit, the stock doesn't just need to go past the short strike or past that strike at expiration, but also has to do it within a certain defined period of time. So in this case, those $670 calls on Tesla, you would need this, Tesla stock to reach 670 within that 14 days to make that profit. Now, this kind of dual objective of having to be right on direction plus timing really lessens then the probability of an option trade being a winning trade when you're just buying options. So, my trading profits formula then is kind of based on trading or looking for high winning probability trade setups with high risk management. So we'll go through that kind of part of the formula. Now, in this Tesla option trade example, you're wanting that stock or Tesla to move more. That would be like 50% in 14 days for this to hit your price strike at 670 expiration. So that's going to be like that. That's 3 standard deviation move, which I'll show you here in a minute. So that's a huge, have to have a huge potential move to get there. So there are not many stocks that are likely to do it. Now, Tesla has been one of the few that in the past has had these kind of big moves, but very low probability, right? So not many. So in all probability, the stock would not reach that strike price, and the options that you bought would expire completely worthless. So it's based on the probability of using standard deviation analysis that in this example, there's less than a 2% chance for Tesla to reach 670 by expiration. So in order to make money on the out-of-the-money options, you're going to need to be very precise on the market direction and timing, or you're going to have to get very, very lucky for that trade to work out. So that's why it's so cheap, because you're taking a lot of risk. Okay, so here's just kind of a standard deviation bell curve, so you can see what the extremes look like. So here's just kind of a normal 1 standard deviation. So that would be like a normal price move up or down. And so that's going to be like a, basically a plus 16 delta on the outside point there, or minus 16 delta there. Okay. Now here's 2 standard deviations. So you can see that tail is just really getting extreme. So very hard to get out there. So you're, asking a whole lot. And so there is about a 95% probability that price will stay within this range. And that's about 2 standard deviations. And then way out here is 3 standard deviations, which is there's only about a 99% probability. So very low, very, very low probability. So that's why those options are super cheap, because you are taking a huge amount of risk. Now, if you get it right though, you're going to get a huge reward, right? So it's based on that kind of risk reward. So here's the option delta again. So I had to go out so many strikes to find this. So, I'll show you here in a minute where the at the money. So it's trading here was 426, and those 670 strike right here. You can see here's your delta. That 670 strike has a 2 delta. Look at that. So you can see then your 2 delta, that's basically a 98% probability right here, 99, 98 probability out of the money. So very low probability the price will get there at 670. So that's why those options are cheap. You can see that the bid ask is 39 at 45. Okay, so that's the reason. Now, if you did get there, man, you're going to get big time rewarded, but that's the probabilities are against you. And if you're not aware of how option pricing works, that's what you're dealing with. So that's the delta is the way that you can forecast that quickly. Now then, being close means no cigar. So, imagine Tesla got to only 554, but that's still a huge move, right? During the next 14 days. Now you're, right on the direction of the stock move, but you're going to be, but since you were wrong about how far it would go within that specific time frame, you're still going to lose money. So even though you got the direction right, your timing was off, and you're going to lose your whole investment in all those options that you bought. So here's kind of what that would look like on your option analytics graph. So here's that Tesla. These were like the 31 Jan 670 calls, 14 days out. And if you're trading, you're looking for it to move up to 670. So you bought those 670 calls strike right here, and you bought 1,065 contracts at $40.40. You've got an investment of over 42,000. So even if you're trading right here, even if it goes up, but you didn't get to that point there, this is trading at 554, you lost 42,600. You lost the full amount. Now it's an equal sum game, right? So on the buy side, you're the loser, but there's somebody on the sell side that's pocketing that big profit put it in their pocket. And that's the market makers or professional money, because they know those statistics. So it's based on this trade example, this hypothetical example, that a better goal then for every trader is to select trades based on what's going to provide you the most consistent positive returns, and not just looking for that big time, one-time winner, right? That's going to get you out of the game pretty fast. So consistency is then going to be derived from making high winning probability trade setups based on reliable data and facts that you're using. So there's that big disadvantage, such as, in the option buy side of this scenario, if you flip the side of the coin, there's the equal opportunity on the other side, right? So in this case, if you were the seller of those options, you've got that huge advantage over the buyer. And this is the professional money. So we want to take advantage of it, start thinking like that. So as a seller, all the things in the Tesla example are the same, but now they're in your favor on the probability side instead of against you. So the seller of those 670 calls at $40 per contract had a statistical winning trade probability going in at 98% or higher, right? So 40 times 1,065 contracts, that's $42,600 with a 98% theoretical winning probability. So that's the professional money. So question, do you ever sell options naked or use spreads to do it? So what I always do and what I always teach is to do spreads, right? Because if you sell, then you have unlimited risk, right? So if you're advanced trader and you have a lot of experience, then selling naked options is a way to go. But I only teach all the different courses and option strategies I teach are all spreads, because I don't want to put you in a position where you have unlimited risk. I always want to have low risk, limited risk type trade setup. So I teach spreads only. But this is an example of selling those options, right, naked. Now, the selling of the option, is great for profit generation and hedging, and you can see the other side of the coin. So that seller of this, selling those option contracts, and at the 670 strike at $40, they just pocketed that 42,600, right? So that's a huge, a good hypothetical example of, probabilities. All right, so step 5 then is then knowing when it is time to sell. So option selling timing tool. So these are the 2 tools you're going to get as bonuses for the course. You're going to get my cycle reversal indicator, and you're going to get my extreme range band indicator. So these are really great timing tools for knowing when it's time to sell or even buy options. So here are just a couple examples. So these are what I call, these are extreme range bands that measure probabilities based on standard deviation. So, and based on what we call average true range. And then the bottom part of the study is my reversal indicator. All right, so you're going to get this tool as a bonus for the course, and this is what we use in the course to give our time to sell and buy. But here's just a couple examples. So here's on the S&P 500 SPX. These are weekly. This is a weekly chart. And you can see that the blue band is like when it gets super extremes, like extreme, like 3 ATR. Now the norm is your, based on the 20 period moving average, 21 period. And so a normal movement is up to this white line, up or down. But when you start getting extreme to that blue, the market's getting stretched. It's getting overextended. And at some point, that's given a signal that the market's going to start maybe stalling. You're going to start running out of buyers and get exhaustion to the upside. So when I start seeing these arrows pop up, which is basically the extreme range band, when the percent, my reversal indicator crosses the moving average right here, that arrow pops up. And that's when it's starting to get extreme. And that's when the market's signaling the market's starting to exhaust. So there's a perfect place if you're doing credit spreads to sell out of the money bear call credit spreads, okay? So it's showing you that the market's, exhausting. So even if it does go up, it's gonna go up just a little bit to sideways and then eventually go down. So it's a great place to sell out of the money, option spreads, or if you do naked options to sell out of the money naked. So this is a really great indicator, and we use this in the course this next Saturday. So I wanted to show you this. So this is my extreme range band indicator with my cycle reversal indicator down here. So here's a sell right there. You can see it had a reversion to the mean there, the 21. Here was another sell right there, and I had a reversion back just the 8. But that's showing you extreme stretched market. So right here, and then here's one to the upside. Here's where it got really hard, sold down, cycle reversal, and you get a reversal of a trend. So it's a really great indicator that we use, for picking extreme sell points or buy points in the market. So here it is on the daily time frame. Just to point out a couple other examples, you can see down here it's the cycle reversal indicator. So you can see it's starting to stall. See it moving up, and now it's starting to exhaust, and then finally it rolls over. So there's a good example there. Here's another one here. You can see the reversal there. Okay, rolls over. So that's what that looks like. And again, this will be a bonus that you'll get for the course. Here's just another example. Here was on QQQ. This is the weekly time frame to show you, extreme conditions when it gets really stretched. Here it was back. This was back in December. You can see right here, it was getting very, very stretched, and then finally had that mean reversion there. All right, so you had another one right here, but here was a big one. These are the ones that get really stretched when it gets to that blue line, and had a big pullback there, right there. And here's one for the upside. Here's where it got overextended to the downside, to the 2 ATR, reverse, and then you had a nice trend established to the upside. So it's a really great tool for timing, selling, and buying. And that's what we use, and you'll get this as a bonus. And here it is, QQQ on the daily. You can see here's a reversal right here. Really nice reversal pattern right here for QQQ based on this indicator. And here's a really good buy setup way back here. This was back in September. All right, so just want to point out a few examples of this tool and how we use it to time buying and selling, of a security. And then we, apply options, either, bear call credit spreads or calendars or butterflies or things like that. And then here's NVIDIA. So here's NVIDIA on a weekly time frame. So you can see it gets huge stretched here, back here, it blew way through that 3 ATR, but that shows you that was the top, right? And then look, it crosses the moving average and pulls back, has one more, and then has a bigger pullback. Here's another one up to the 2 ATR, pulls back. And then here was just recently. All right, so there was NVIDIA, and just threw in here one more. Here's Apple. You can see just how clear it is when this when your security gets too extended. So here was Apple getting really extended on the weekly, back up to that 3 ATR, had a reversal here, pretty big pullback. This is not too long ago, right? Here's another one. This was back in July, August, reversal, pulls back. Here was another one back in August, nice pullback. Here's an upside reversal there. All right, so that's an indicator to help tell when it's time to sell or time to buy. And again, this is going to be part of the bonus package indicator that you'll get. So let's take a look at kind of quick market review here as well while we're doing this, and let's see what we're looking at going forward. Let me pull up my charts here. 1 second here. I'm going to pull up SPX. We'll just use that as kind of the overall reference chart for the market, and I'll put this. So what I like to do is what I call top-down market analysis. So go out to the macro time frame, which with the charting we'll use the monthly time frame, and that is what I kind of refer to as the macro. Okay, so that's the really big picture. And so if we look back at the macro here, I'm going to put this on monthly. Then we start out here, we can get a big picture view of the market. So you can see we've had a beautiful break to the upside. So this broke, this is what we call a volatility squeeze, but see, then it triggered and look where we went. So this is back in November of 2023. And then look at this beautiful trend. This is the 8 exponential moving average on a monthly. Look how perfect that was. Just a perfect trend to the upside. It just had this one pullback here back in August of 2024, but then pushed back up. Now we're sitting right here. We're still sitting on top of that. We've only had one pullback here to that 21. That was back in November 2023. So just a huge trend. But you can see we're overbought on the monthly, but you can stay overbought for extended periods of time. But the thing that I look at is momentum. So this right here is cycle 1 is a really fast momentum measurement, and 2 is a slower confirming momentum. But you can see the monthly is still positive. Now it's come off, so momentum has come down, but it's still positive, right? So this shows you this trend is very, very strong. Now we could have a reversion back here, but we'd still be in this uptrend. It could go back here to like 5,500, but you're still in that uptrend based on that big macro moving average right there. But we are overbought, but you can see how extended and overbought it stayed here, and it just kept grinding up. So markets can grind up for extensive periods of time because you get little bits of buying coming in, buying coming in, buying coming in. It supports the market. You have buybacks for stocks, et cetera. It supports the market. Now, when markets go down, they crater because everybody's running to the exit at the same time. But the macro, looks good. Okay. So if I look at that, and then the next time frame, I drop down to what I call the long term, which is the weekly time frame. And this is, getting a little bit of a, momentum is stalled out. So we're neutral momentum. We've got negative momentum on the weekly, and we've had the market volatility's picked up. We've had, price movement a lot more choppy and jittery over the last few weeks, right? We had a beautiful trend up, but then over the last, since early December, we're starting to get a movement back down towards that 21. And this is a critical part. So here's the S&P 500. So it needs to hold this area here, this 2796, which would be about 5,800 basically. So that'd be like 580 on the SPY. So this is a key area it needs to hold. This is the prior month's low, but you can see negative momentum. So things are starting to stall out. But you can see here, when you look at cycle 1, which is a really fast momentum measurement, 2 is slowing confirming. You can see what happened here, and you see where it pulls back here. So it pulls back, but it pulls back just to the 21 and holds. You can see cycle 2 is still positive the whole time. So this momentum here has always been positive. So we had that pulled back to the 21, held. Then we got a little bit more pushback to the upside. We get a pullback here. It did break the 21, pop back. So right here, we're in a conflicting area here. We need to be careful over the next week or two. So we'll see what happens. We've got Trump coming in next week. Markets are trying to hold support. So this is going to be a key area to be watching over the next week or two. Then the next one is to drop it down to the daily, which is the medium-term swing trade term. All right, so you can see we had a pullback here. You can see we broke the 50, simple. That's a key moving average, that solid green. But we bounced back above it. So we've been bouncing around that 50. And then on Friday, we bounced back above it. All right, so right now we're getting positive momentum. So we could get a little bit more potential upside if there's no, if the market's absorbing Trump coming in and see what he does is on his tariff policies. If those are more a gradual introduction to the markets are going to probably deal with that okay. And then we can get, the trend up. So momentum though now is starting to cycle back up. All right, so, right now, potential long is still the possible outcome over the next week or two, but we're going to have to, watch closely to see, if these key moving averages hold. So needed to get back over this 50, and on the weekly, just a real quick, needed to hold this weekly 21 period moving average right there. That's coming in about 5,800. And if you just relate that to the SPY, that's like 580. So it really needs to hold in here. So it really needs to hold this level right here, this 580-ish level. Now, if this breaks, it's going to have a quick move down to 555, that area there. So that's how we'll be looking to play it, on a really a break and a close below these areas here. We'll be looking for shorts, but it's trying to consolidate and hold. If you flip it to the daily, which is the medium term, it's trying to build that base and trying to hold. You can see it's back over the 50. So next week, what it needs to do is just back and fill right in this area here, create a little bit more support, and then that's going to create a kind of a level of support level. So if it just starts, doing that, then it's going to be an area of support to launch to the next move up, which would be potentially back up here. So there's the possibility for that. All right, but we'll see what the Trump thing comes in and how that affects the markets. So that'll be key. Now, step 6 then is selecting the option income strategy. Now, one major goal for every trader then, is to select trades based on what's going to give you the most consistent positive returns, again, with low defined risk, and not always looking for hitting that home run. So, let's take a look at some of the different option income strategies that are available, how they work, and then select the one that's best suited for you. So it gives you an example of the different ones out there, and then which ones may be, the ones that fit your risk profile. Question, is your analysis based more on indicators than price action, or a combination? It's a combination of the two. All right, so, look at, when we look, just a quick example here, I like to use momentum, to give potential direction, right? So when we start having momentum start cycling up, then I'm looking more higher probability for upside direction. And then I'll look for price action to give me areas of support and resistance that we can trade to or hold for downside support or upside resistance. So those are a combination of two things. All right, so then what we're going to look here at the different selling potential strategies based on spread. So we're going to look at a vertical credit spread. We're going to look at the iron condor. We're going to look at the long condor, totally different animal, and then what I call opportunistic hedging that you can use, but with selling types of spreads. All right, so first is the kind of the number one is the vertical credit spread. So this is an income kind of strategy, and there are basically three types of credit spreads that you can do. You can do what we call the bear call credit spread, or the bull put credit spread, or the combination when you combine the two, that's what we call the long iron condor. Now, when you look at the bear call credit spread, this is going to be one that you're going to use if you think the market's maybe going to go down, but it doesn't have to. You just go sideways. That's where that trading tool is great, because we don't have to have the market go down. It can just go sideways, and we're going to profit from that time decay of the sell side component of the spread. So this is a bear call credit spread. So it can make money over time, even if the stock stays stagnant. So basically what you're doing is you're going to sell a call while at the same time you're buying another call with a higher strike using the same option series. So these are what we call a negative risk ratio, okay? So if you look at the risk profile of this is an example of selling a bear call credit spread. So this was selling the 1020. This was back on the NDX. So if you sold that call there, the 1020 strike, that was at a 20 delta, okay? So that's a probability that you're going into this trade because you short strike here was a 20 delta. So theoretically, you're starting out with an 80% probability that price will be below 1020 by expiration. Now, so we're going to cap the risk though. So we're going to be short that 1020, but we're going to cap the risk in case we're wrong with the 1030, which is right here. So we're going to buy that call. So you can see this is a $10 wide spread, which would be $1,000, right? You know, one option contract's worth 100 shares, so $10 wide spread would be 1,000. Now here you can see your profit is your premium you receive. So that is $200. That's the credit. That is your profit. So you're going to make $200 if at expiration the price is below your short strike. Now this goes straight to your bank account, and you put up the difference, which is your margin. That's what you could lose if you're wrong, would be 800. But that's the max you could lose. So you're going to deposit with the broker 800 bucks margin. Now, if you're right at the end of the option series, you know, when everything's closed out, that's a 25% return, right? So that's what we call a negative risk ratio. You're risking $4 to make $1. And so you're saying, well, why would I do that? Well, that's what we're talking about, the probability trade, right? So you're having a probability going in of 80%. That's why I like to combine, you know, bear call credit spreads with vertical debit spreads, and we get the kind of the reward of both. Now here's a bear call credit spread cycle high reversal example of SPX that we had. And again, this shows you the tool, you know, how helpful it is for timing. So this was the weekly time frame. You can see we're getting this reversal here. We can see it's been grinding up, and this tool is great. When you get 1, 2, now when I get 3, it's unbelievable. When you get 3, that's when it goes down. Look at this, 1, 2, 3. That's when it really corrects. But when you start getting this, it's showing you that the market's starting to slow down. So here you can see it came here, and then it went up, but not much, right? And then you had one more surge, and then boom. And then look, you had the reversal here. So this is where we sold a bear call credit spread, buying exhaustion, sold this way out of the money up here at about a 20 delta short strike. All right, so went out and this was on the 10th, sold and took profit 2 days later because we got the timing perfect. All right, so we sold the 52.65 short strike right there. It was trading right here, and this was I believe a 20 delta. We'll see in a minute. So it was trading right here when we set the trade up, and sold here one standard deviation out of the money, a little bit over, okay? But we got the timing, that was key. So momentum was also negative, and we had a cycle reversal. So everything was set up perfectly based on momentum and time and things like that. So then we sold the 52.65 call short, bought above it the 52.70, $5 wide spread. So we had the short strike at 52.65. It was actually a 17 delta. So that was an 83% probability trade based on that short strike, you know, being a 17 delta. So we had the trade set up and then took profit just 2 days later because the market fell off hard. We got that benefit and was trading at 51.19. So went ahead and closed it out. We set the spread up, we brought it in at $100 and then took it off for 70% of the credit. So typically we'll look at, you know, 78% of the credit, you just take it off and go down the road. So, you know, 18% return, but that was a probability trade. of 83%, that you would make. And then we also had a great timing with the timing tool here, showing us it's time to sell, based on being overstretched right there. All right, so it's a combination of these things together that give you these high probability trades. Now, the next one, credit spread, is what we call the bull put credit spread. So it's going to be best used if you think the market's going to go up, but it doesn't have to go straight up. It can make money over time, even if the market churns sideways. All right, so this one is you're basically selling a put out of the money while at the same time buying another put with a lower strike in the same option series to protect it if the market keeps going down. So you're just not naked that put. And again, this will have a negative risk ratio from doing this because it too is a probability trade. So here's an example. This was like Apple risk profile. And so this was selling the 149 put short right here. And that had a 20 delta at the time. So that was giving you a theoretical probability of 80% probability that price would be above 149 expiration, but not to short it naked, then bought the 144. So we've got a $5 wide spread between the short strike and the long strike, okay? Now for doing this, we then brought in $105 credit, all right? And then the difference is your risk. So this was, a $5 wide spread for $500, received $105 credit or premium for selling that spread. The difference is your potential at risk, $395. That would be your margin you put up, and that's your max loss. And you can see then your return, if it, was to close above 149 at expiration, that's a 26% return. So in this example, you're risking $3.76 to make $1. Again, it's a probability trade, and that's how that works. All right, so that's an example to put. Now, when you put these two together, here's an example that we did on AMD. It's a good example to show the timing. So you can see AMD was trending lower and got down close to that 3 ATR here. Then we had a reversal up. So sold a bull put credit spread out of the money based on that reversal arrow. All right, so it gives us a good high probability trade entry, but good timing for when we did the entry. All right, so this was a bull put credit spread. So went out and sold the, it was traded at 86 and sold it was a 20 delta short strike. And so this was selling the 77 put, buying the 72 put, okay? So here was the bull put credit spread here, short that, short that 72 put, and then long the, short the 77 right here and short the 72, short the 77, long the 72. All right, so did that, brought in $95 credit, so nice credit, and then closed it out, at $4. So that's a, $91 profit. So that's a 22% return over an eight-day period. So those are the, basic credit spread on a call credit spread and a bull put credit spread, and then the timing is really key. Question, are you always targeting 20 delta for your short strike? Yeah, typically targeting about a 20 delta. So that gives your trade going in a, theoretical 1 standard deviation short strike out of the money. Now, if you want more premium, you can go, a greater delta, right? But you're increasing your risk, right? So if you want a lot of premium, you can go to a 30 delta, but then your probability is like maybe 70%, right? If you want even more premium, you go to 40 delta, right? But then your probability is only 60%. So you can see how it plays, but you're going to make more, obviously, but you're risking more as well. Now, here's the iron condor credit spread. So it's the combination of the bull put credit spread and bear call credit spread. So when you feel the stock you're trading is going to be in a very tight range between two strikes and stagnate, the iron condor is an ideal strategy for premium collecting that will seek to minimize your potential losses should the stock move against you. So again, this is going to take advantage of time decay and volatility. So it's two credit spreads together. So here's an example of one that we did with Tesla. Okay, so this is going to be a short bear call credit spread, okay, and combined with the bull put credit spread. So it's going to have both credit spreads together. Now, the good thing or the cool thing with the iron condor, we call this a long iron condor, is that we can leg in and out. So we could we could do the bull put credit spread first. So if the market's starting to turn up, I'll typically look to do the bull put credit spread first, and then I'll look to see if we get a little bit of movement. And then when it starts to turn, then I'll sell the bear call credit spread, or you could do it either way. So this is what we call the long iron condor, and it gets its name because you're long the body. So, I mean, you're long the wings right here. So you're short the body, long the wings. That's how the broker identifies a trade, which I would do it the other way around. That's how they quote a trade. All right, so long the wings, short the body. So you're long iron condor. So here's the one that we had set up on Tesla. Okay, so Tesla was, trading down here. You can see it was trading right on the lows. We had this pop up off that 200 right here. So a really good close with that candle back above this moving average, back above the 21. So it looked like, and there was good momentum. So this looked like a position for it to move higher. So sold the bull put credit spread first, which had a short strike of 237.50. And then we had that movement up that day. And then when it started to stall, then we sold the out of the money bear call credit spread with a short strike of 267.5. All right, so legged into this. So the first part was doing the bull put credit spread when it was starting to roll back up. So sold the 237.5, 235 bull put credit spread, short strike 237.5. That had about a 20 delta short strike, 80% probability going in. And so sold here the 237.5, bought the 235. So short that put, long that put. So, hedge position. If you, wanted to, you could have just gone short the put. All right. So then when the market started on Tesla started moving up based on our indicators and timing, the tools that we use, then we turned around and sold before it turned that day, sold the bear call credit spread. That was the other part of the leg. All right. So when it started to turn back around, it was then traded at 253, sold the 267.5, bought the 270 right there. Okay, sold that call credit spread there. All right, so that added together created the iron condor. All right, and brought in 38 bucks credit. So the combination of the 38 and the combination of the, hold on, and the combination of what we received for the put of 60 gave us a full $98 credit on the iron condor credit spread. All right, so we legged into it. So we had the 267 at 270. We sold that. That was at a 23 delta short strike. The 237, 235 was at a 20 delta short strike, and we received a maximum of $98 credit. All right, and it's a $2.50 wide spread. So the potential risk is the difference of 152. So that would be the margin that you put up, and that's all that you could lose, right? And so then you've got your premium is what you would make. And so that's a 64% return. So these are kind of normal types of returns that you get for a credit spread and things like this. So then here's your profile, what it looked like. So you've got your bear call credit spread here, right? And then legged into it first, so that bull put credit spread first. And then it moved up some, so we got more premium from the bear call credit spread. So 60 bucks on the put, 38 on the credit on the call side, and you can see this went out at 4. This was at 3, so the combination of that gave $91 profit or 60% return. So trading right in there. All right, so that's a typical look of what you're going to want to do, and this is kind of trying to trade range bound type of play. Let me just check out this question here. Yeah, sure, Stephen, you can do that. Yeah, just send us an email if you want to ask any questions you have. Let me just put that in. Send us the email at support. So send us an email there with any questions that you have. Okay. Oh, yeah. And here, Joan, here's the link here. 1 second here. The link for the course Let me just put that back into the box here for you. Then we'll move on to the next thing. So here's your course link if you want to join us next Saturday. Thanks, I hope you do. And then if you want that 15% off, just put in sell 15 small cap, when you put in the buy side or, on the promo code. Now here's the long condor spread. So this is different from the short. So this is different from the, iron condor. So in this one, you're going to be long the body and short, long the wings and short the body. Okay. Okay, so let me show you what this looks like. And in this example, with the long condor, I call it long condor debit spread, so it's not confused. So I'll put that in debit spread. So in this kind of trade, you're long a call, and then you're going to be shorting a call further out to bring in some credit. So really, this really is a great trade because you get the benefit of both. You get the benefit of potentially big profit from the call debit spread side, or you can do it with puts if you think a downside move. But then you have that negative theta from a debit spread. So we can offset that theta by adding the credit spread plus reduce our capital at risk. So this is what we would look like as a long condor debit spread, I call it, so you're not confused. So the difference here, let me just show you the two different ones. You've got the iron condor let me just pull up a notepad here, and then you can kind of not be confused by the difference between the two. We're going to call it an iron condor credit spread versus the long condor debit spread, okay? So these are the two that we just reviewed. All right, so the first one was we'll call it the iron condor credit spread. The risk profile, they look very similar, right? So it gets confusing, but this is the iron condor credit spread. So short a call, long a call, short a put, long a put. So the profit, your return on this is just your premium you receive, that no more. So if this was, let's say, a $4 wide spread, say $400, and you receive $50 here and $50 here, that's a total of $100, right? So then your potential risk is the difference of 300. So your return on that is like 30%, right? So that's it. So that's a negative risk ratio, but that's a probability trade, and that's typical. So that'd be like a 33% return. Now the long condor debit spread looks kind of similar, but it's long a debit spread with the credit spread. So, we could be long a call debit spread, have a really big potential, payoff, but then we're going to sell another credit spread further out of the money to reduce our capital at risk and reduce our theta, giving us positive theta. Question: how do you manage open option positions? Well, you just monitor them each day. You can set alerts and things like that. You just look at them during the day. Know where your break evens and stuff like that. There's a lot of different ways to do it. But join us for the class, and I'll go in more detail of how that's done. But it's not complicated. It's very simple once you get a kind of a format together. So here's an example of one that we did. Google long call condor debit spread. Okay, so Google is trading right here. You can see where the arrows had good, nice positive momentum. So that was giving us potential direction for the upside move. It was in a volatility squeeze, so we're looking for this to break and then set this up. And then we had a profit take here and here. So this was trading when we got in at 179.50. And then we had a profit take on the 27th. It was trading at 185.41, and then again the next day it was trading at 182.29. All right, so let me show you this. And so this is a combination of a call debit spread, 180, 182.5. So we could leg into this or do it all at once. Typically, a lot of times, if we don't know the really good direction, not good timing, we'll just do it all at once or leg into it. Yeah, well, they'll link it, yeah, automatically. Yeah, the spreads when you do it, it'll automatically link up. So this was the long call debit spread side here, okay? And then the other part of the trade was right here, the bear call credit spread, the 185, 187. So it looks like that, right? And so you can see then the spread width here is $2.50 wide, 180, 182.5. So both sides. So $250. Now look at the risk, 72 cents or $72. That's the max risk is your debit paid. Okay. Now if it goes out in here or anywhere between the two long strikes, you make a profit. So this one had potential to make $178, which would be a 247% return. So look at the difference between the two. So earlier I showed you an iron condor credit spread, right? So if you did that one, like I pointed out, let's say these are $4 wide, and you received $100 credit as a $4 wide spread. So you make $100 on your risk of 300. So that's a 33% return, right? So that's an iron condor credit spread, a probability to trade. But this trade, if you get it right, your risk is 72, but look at your potential profit, 178, 240% return, you know? So it's just, but it has a sell side component. So what I really like is doing spreads to take advantage of selling options, but also have a long option part of the trade to give you that extra pop, you know, that extra profit. All right. And so here's what Google looked like going out. So on the 28th, it was trading at 182.29. So the spread you can see here was trading at 182.29. It was trading right there. So the spread went from 72 cents or 72 bucks to 243. So there was your profit of $171 per spread. So if you did one spread, you make 171. If you did 10, you make 1,170. That's a 237% return. So, you know, really nice return, positive risk ratio, you know, no theta decay, and potential for, you know, nice returns. And then here's one, what I call opportunistic hedging. Okay, so here's an example of a long put debit spread that we had set up and then adjusted it to a free trade into a long put condor. So, you know, when you're trading, especially trading options, you should think 2 or 3 steps ahead, like you're playing you know, cards or playing chess. Think of what your next move is going to be if certain thing happens. So in this one is an example of a put debit spread. So if market collapse, we were going to look, can I convert this to a condor and bring back all the premium that I paid for the put spread and make it free, or make it less risk. So here's the trade and how this worked. And this is what we'll be going into in much greater detail in the course. So this was on the 28th. QQQ was trading right here, 365. And then, you know, our momentum indicators were down, you know, looking for a break. And so here it broke a key support. Market sold off hard. Now, when it got sold off really hard and it got down here to this area here, 355, we sold a bull put credit spread to recoup the debit spread from the put debit spread. Okay, so that actually at that time put it into a free trade. So it was trading at 365. It dropped hard down to 354.53, adjusted it to a put condor, and then took profit. A few days later, it was trading right there for max profit. But we had zero risk in the trade after doing this quick hedge. All right, so here was the initial trade right here was the long the OC 364, 360 put debit spread, okay, right here, 364, 360. So this cost a total debit cost of 121. Nice positive risk ratio though. See, it's a $4 wide spread. So potential profit 279 if it closes, you know, below that short put strike, or long put strike there, and that 230% return. But, you know, a lot of times in the markets, you'll notice that we get a hard move down and then a bounce back up. So these are great trades to take advantage of that potential bounce back up. So, you know, when it moves hard down, then you put the other side of the trade on. So you've got the premium you're bringing in. So then if it pops back up, you've locked in a big, huge potential profit zone with lowered costs, lower capital at risk, and also giving yourself more positive data. So then when it dropped down hard, set up the other side of the trade. So here was trade 2, and it was trading at now 354.53. So then sold the bull put credit spread at 354, 350, same option series, and brought in a credit of $141. See that? All right, so trade 1, the original trade, we had to put debit spread for $1.21, but then when it dropped down hard, sold a bull put credit spread for 354, 350, brought in 141. So look here. So now we have a credit of 20 bucks. So even if the market went back up outside of our long leg or back down outside of the long leg, you'd still make 20 bucks. But if it goes out anywhere in between here or between these two short strikes, you make your max profit. So it's a really great strategy for legging back into, and this is a big part of what we'll talk about in the course and go through. So we had zero risk then on the trade, actually a $20 credit, and it goes out right here at expiration on the 7th, trading at 359.67. So this was up $420 on zero risk. All right, so that's how you can really do some great hedging and control your risk. All right, so we had a credit of 20, potential to make 420, and that's what it actually made, 420. So, if you'd like to learn that, how to master these, types of option strategies for income, profits, and hedging, again, I'm going to be doing a full master's course, next weekend, starting Saturday on these strategies. So we'll start 11 a.m. Eastern to 2 or however long we need to get through the material for Saturday. And then we'll finish up Monday, the 27th at 4 p.m. Eastern. And here, use this link here, and we'll go through all the course details, what I'm going to cover in the course, and then all the bonuses and any other questions you have. So just click on that, and then that's going to give you the drop down, and then you can, put in that sell 15 small cap, and you'll get that 15% off of the 2 different packages. Okay. So with this, it's a 4+ hour course just on these strategies, which I'll go back through and show you what's going to be covered in the course. So with the course, you're going to get, these bonuses, and these are tools that we'll use in the course. So you're going to get, these are my prices on, if you go to my website, I'll just show you real quick. These are the prices on the website. Get rid of this drawing tool here. So if you were to wanted to check it out to the website, right here, you go to my website, powercycletrading.com, and then go over here to trading software. You can see here, you're going to get this solid trading software that I've developed, but you're going to get these 2 tools here at as your bonus tools that we're going to use in the course. So you're going to get this here. You're going to get the cycle reversal indicator, and this is for Thinkorswim, TradeStation, TradingView. Also available for wealth charts, and we've got, this is price here of 197, but today you're going to get that at as a bonus, no cost, and then you're going to get my extreme range band indicators available for Thinkorswim, TradeStation, Engine Trader, etc. So you can have any or all of them if you want, and this too is, you can see here, 197. And then the other thing you're going to get is my Fibonacci price target mapping course that we'll use to set up our price targets. So it's a really great course based on Fibonacci, moving averages, and how I use it to set targets for, price targets, profit targets up or down. So this is the course here that you're going to get as an additional bonus, and it is $297. All right, so there you go. So those are bonuses there, and then use that. So here's everything you'll get for the course. You'll get that indicator, you'll get the Fibonacci course, and then you'll get a 30-day membership to the trading club. You can start this whenever you want. You can wait till after the course or start it right away. So that's part of the bonus, and then we'll do a follow-up live and recorded Q&A. We'll do this the next day, so this will be probably Tuesday, so you're fresh. We'll do that, and then you're going to get my option trading tutorial. Another option course is thrown in there. So You know, a lot of great bonuses. So full package value over 2,800, and this will be 197 when I go out just to the general list that I have. But today, if you use that promo code SELL15, you'll get it for 167. And then if you want it with my alert service, yeah, Michael, you can activate it now. So question for Michael, he had the alert service and he hasn't activated it yet. So yeah, you can activate it now. And if you wanted, you know, if you did this package with the alert service, you would get it for another 4 months. So you'd have 8 months if you want to look at it that way. All right, so this is package one. Okay, now if you do want my alert services, which have been really great, you can do this. You'll get everything in course package one. You'll get all the bonuses, all that good stuff, but you're gonna get my 5 alerts that I send out, 5 different type of trade setup alerts that I send out. And you'll get those for the next 4 months. And like Michael, and then you'll get my trading club as an additional bonus to it. So 4 months to that as well. Now you can start and stop this service whenever you want. So Michael bought the alert service with a course that he package or something he bought couple months back, and he hasn't used it yet. So you know, so but you can still. So he hadn't used it. He hasn't used his time. So he can still. It's still available to him. All right. But if you go on a vacation or something, or work or something, you have to leave for a week or 2 weeks. You can stop it and then start it back, so you're not going to lose your time. Now, the alerts that I send out, they're all very selective. They're all option spreads, okay? A lot of members just do the alerts and they do their own thing. They'll just buy the stock, they'll buy calls, they'll buy puts. They just want the trade set up. They just want the trade set up. But when I send out a trade, I'll always send out with an option trade. So you'll either get a selective trade that I think, okay, we're going to do a butterfly or long condor for this setup because that's what the market conditions look like it needs to be. So this is one type of a trade that you would get. We do a lot of these. The other one that we do a lot of are calendar diagonals. These are another different type that would be sent out. And then we do another thing that I call the butterfly pinning trades. That these are very selective. These are sent out. And then we get breakout reversals. These would either be debit spreads or credit spreads. And then we're in earnings season, I'll send out selective earnings trades. So there are 5 different types of trades that can be sent out during the week. So it just varies on what the market's given us and what the opportunity is at that time. So then you can take it or not take it, but it gives you a lot of different trades that you can look at. So then if you look at this, so you get 4 months of that, start and stop when you want, plus 4 months with the trading club, which we'll go through. And so you'll have access to all 5 of these alert service type alerts that are sent out for the next 4 months. These are going to be either on stocks or ETFs. So, anywhere from 8 to 12 a month. And it would be, like I said, butterflies or condors, long condors, counter diagonals, pinning trades, credit spreads, breakout type trades, and earnings selective trades. So when I send it out, you'll get a trading guide for each trade, the option trade setup. You'll see stop loss levels, or you'll see profit targets. I do a video review of the trade that afternoon after the close, tell you kind of why I did the trade, what we're looking for. Trades are listed in archives, so you can go back and look at them. Then you're going to get my access to my trading club, which gives you access for the next 4 months to my weekly Q&As, which are live and recorded, my video newsletter after the market closes, what the markets are doing, my views of the market the next day, etc. And then here's a big plus, access to my virtual trading room or coaching room. So each day during the week, this is open from 8:30 to 9:30 Central, and for the next 4 months, and 60% off on any course or software on my website. All right, so the trading room is great. If you have a problem with the trade, or you want to see what we're doing, what trades are coming up, or if you have a question, hey, I like this trade, what do you think about it? Come on in and ask whatever question. So again, use this special link here, take advantage of the link here, and again use that SELL15 and you'll get that discount today. off of that course price of 197. So 197 today, 167. So you're getting 94% off based on all the good bonuses. If you want to do it with the alerts, 507 today, and there's a to pay for that as well if you want that. All right, and again, if you want to see if you purchase it, you just go to your customer support area. You can see all the courses that you've done there. Now, as far as the bonuses, these are just, part of the course. So maybe you already have it, but, I'm not going to substitute, but this just, these are additional bonuses. So the course is just, what it's worth, 197 or 167, but you're just going to get all these bonuses on top because we're going to use these in the course, when I teach next Saturday. Yeah, so the alerts, I send out a lot of updated alerts to tell you instructions. So for example, here, let me show you here. And we use what we call Telegram. We use a system called Telegram. It's a free service. And so I sent out a lot of detailed descriptions on the trades that we have. We did an earnings trade here on Slumberjay, for example, right here. This was a selective trade that was sent out on Thursday. Okay, so for example here, so it's very detailed. So even if you've never done one of these, you can just follow along, and it's very detailed how to do it. Now, and so this was sent out. Okay, and then this trade, we had a couple different things that we did. I gave you some different options that you might have wanted to do if you did the trade. So, here, just for example, let me go down here. We ended up doing, so let me just show you. So here it says, so sent out, it's kind of, the fonts are kind of small, but so here was the next day, and then Slumberjay had a big rip to the upside. It was trading at 44. So based on the big price move up, not going to leg out into the long. Okay, so set that out. All right, so kind of description. And so then what I was saying we're going to do, we're going to look today to close out at a break even for now. And then I sent out another alert. I'm constantly updating these things that we need to do detailed stuff. So here was a good example. So then later, sent out alert to say, okay, I'm going to look to leg out. This is one option. Try to close the whole spread out. Here it says options. Look to close out double calendar at around break even or 2. The other option is on a pullback, look to leg out to close trade. So going to look, and I described how to look to do that. So sell to close the 24 Jan 42 call for a profit, and then buy to close the 17 Jan 42 call, and then sell to close the 39. So go through exactly how to go about doing it on that one for a leg out. So I'm very, very detailed on these alerts, sending out a lot of updates. Okay, so hope that kind of gives you an idea. Now again, for the service here, overall started back in 2018. The first one I started out with just breakout reversals, credit spreads, but then I've added to the alerts the other kind of 4 different categories. So we've had 825 trades closed out, 593 winners, 54 break even, 178 loser, 78% win rate. These are unaudited, just summary to kind of show you, what they look like over time. And then here is, we'll just go through a few that we've done here recently. And this was from Pam. She was doing credit spreads, and this was a course that she took that really helped her. Said, just sending a quick note of thanks to you that you could maybe pass along to Larry for all the fabulous teaching through the years. Truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to do trades than Larry. Now, here's the course, kind of the outline of the course. So we'll start this again next Saturday, and then we'll have the follow-up on Monday, and then we'll do the Q&A the next day. So this will be live and recorded. So we're going to first, I always like to kind of start out with the option Greeks. Okay, so we're going to go through the Greeks and the importance of the vitals of the option Greeks for selling options and option credit spreads. more in-depth, how option delta trade probabilities work. And I kind of touched on it today, but we'll get into that in much more detail in the course. And then I'll give you in the course as a handout my option selling guidelines and the rules that I use, the pricing, the option, how that works, and how the affects time decay and volatility. Then we'll cover also go back over price target mapping and standard deviation analysis to set our probability targets for the trades. And then, what are the best markets, timeframes to use? And then we'll go through, how to use the two indicators, the cycle reversal and extreme range band indicator, for giving us those signals when it's time to sell or time to buy. So we'll cover that in the course. Those are the two indicators that you get. And then we'll go into the 4 best option selling type strategies. So we'll go into these strategies, when and how to use. All right, so we're going to cover step by step on how and when to set up and use the bear call credit spread, the bull put credit spread, the iron condor, and then we'll get into the long condor debit spread as well. So when to use the bear call credit spread versus a bull put credit spread or iron condor. What are the best market conditions for these types of credit spreads? What are the best time frames for entering these credit spreads? And the 5, best known rules for these spreads. So there's some really good rules that I'll send out and give to you for this. And then the next part is, when to use and how to use that long condor, right? So this is a really great trade structure. And so going to go into exactly when to put on the long condor, how it works, not to be confused with that iron condor. So you're going to know the difference by the end of the course. How a low capital risk strategy that delivers returns of 200 to greater returns with always a positive theta, no time decay. And so what are the big advantages and how to use those? And so this is going to be also go through the step-by-step guide for combining these vertical spreads to construct the long condor to give you increased profits at lower risk. And then also how to adjust these types of trades into a lower risk trade or even into what we call a free trade. So you'll get that. And then part 3 is going to be dedicated to hedging, okay? So we're going to go through hedging guidelines for using these option strategies. So how, why, and when to use a credit spread for hedging a core trading position. And then also when and how, why, and when to use the condor hedging defense. Okay, so 5 ways to hedge a credit spread. So this is going to be a big part. So if you've ever done credit spreads and you've gotten your short strike penetrated, you're going to want to, take this course to learn how to defend credit spreads. Okay, so we're going to go through that as a big, nice part of the course. You'll have the course video. The question is, how long do you have to access the course videos? They're yours forever. So as long as I'm around, as long as we're still at Power Cycle Trading, they're yours forever. So you'll have a vault where you have your material and you can always access it. If you do lose your login, you just let us know. We'll give you a new login. All right. So then all tools and tricks of the trade. So we're going to I'll also go through if you're ever worried about assignment risk. So I'll go through and explain how that works, how expiration risk works, how auto exercise and assignment works. And then you're going to get an option library of some really past trades. A lot of really great ways to, a really great way to learn is to look at past trades. So you're going to get a really good trading library so you can go back and kind of look at past trades and kind of give your idea of how those trades worked. All right, so that's everything here in the course, and then you're going to get this indicator here as a tool for the course we use as a course. So this is a two study upper and lower study indicator that I developed. This is called a cycle reversal indicator. So you have the upper study, but the lower study is actually where you get the reversal signals. And then if you want to program, I'll show you how to do it in the course, where you get the arrows on the top part of the top part of the indicator. So have this for Thinkorswim, TradeStation, TradingView. And then this is what we'll use. So, you can see here, went through a lot of examples earlier, extreme range band selling and, buying, etc. So you're going to get that as a tool. And so that's your bonus. And then you're going to get my extreme range band indicator. So this gives you those extreme range bands, based on standard deviation when it gets too stretched up or down. So this is a really great tool that we use for markets that have been really trending hard to the upside or hard downside. So this is available Thinkorswim, TradeStation, eSignal, Ninja. You can have all or one, depend on what platforms you're using there. And so these are those extreme range bands. I showed you, all those different examples earlier. So here's a really extreme with a reversal right here. Okay, so you're going to get that as a tool, and then you're going to get, this is such a great course, but this is what I use for every trade that we do. This is what I use, I call it Fibonacci price target mapping. So this is a course, 3+ hour course that you get as a bonus. So this takes you through what I call Fibonacci price target mapping, and it's a combination of using Fibonacci plus price action, okay, plus moving averages, support resistance, so price action, and then standard deviation, price forecasting, and then any unusual option activity. So 5 different things I'll look at, and that's what's covered in the course. So you get that as a bonus. So just that alone, this course is $297 on my website. And then you're going to get a 30-day trial membership. Okay, so you can start this when you want. If you do the alert service, you'll get this for 4 months. And so with this, you're going to get access to the virtual trading room every day during the week, 9:30 to 10:30 Eastern. So come in and ask questions on any of your trades, see what we're doing. I do a daily video newsletter every day after the close, members trading archives, so different things there. We do a live Q&A, which is also recorded every week. Traders Educational Vault, 60% discounts on every course and software on my website. So I've got a lot of great stuff on my website courses. So this is something really true. This is Jay, one of my very old members, said reading books is fine, but seeing the actual option trade setup makes a huge difference. So come on into the trading room. And then bonus 5, we're going to do a follow-up Q&A. We'll probably do this the next day. So this will be live and recorded. Plus you get the virtual trading room. So if you have additional questions regarding the course, come in there. And then you're going to get my option trading tutorial, just one more option course. This is a 60-page option guide with videos on the Greek. So showing you how delta, gamma, theta, vega work, option pricing, market maker secret, more standard deviation, and delta probability. So just a lot of option material for everybody here that you'll get. And then here's kind of a summary of some alert trades that we've just recently sent out to just give you an idea what you would get if you do sign up with the alert service. So here's just a little comment from Dan. He says, you're very diligent and totally thorough with your analysis. That's the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was learning how to trade options. Please feel free to share this with your other participants. And that's a lot of the members do that. My alerts are so detailed. And then Scott said, it'll be the best investment that you'll ever make. Go with the elite package, great group of traders. So then again, when I send out the trades, again, so a lot of members just want the trades and then do their own thing, but I'll always give you a suggested option trade that I think is the appropriate one to use. What are the entry levels for the trade, profit targets based on option mapping, what option series to use, stop loss levels and guidelines, and then trades are archived, so you can go back and look. So that's kind of a rundown there. And then I do a trade setup video review after the markets close. You get the video newsletter every day after the close, then access the weekly Q&A live and recorded, access the virtual trading room. So you're going to get all this as part of the trading club. So you'll have this for the next 4 months as well. And then 60% discounts on everything on my website, courses and software. So here's kind of some recent alerts to give you an example of how they work. So here's the calendar diagonal alert service. So started this one back in June of 2019, and through yesterday, we've had 321 trades closed out, 232 winners, 18 break even, 71 losers, 78% win rate, so unaudited. But we do a lot of these because these are certain conditions in the market that are just great for us. So you'll learn a lot about these, if you join the club and or if you take this course in general. But here's one that we just did recently. This turned out this was a great one that we did. This was on XLE, the ETF. So we did this with the calendar diagonal, but then we adjusted this a couple times and ended up adjusting this to a free trade, okay? Just like what I was talking about earlier. So we got into it 85.70 and then adjusted it to a free trade. It was trading 88.17 and then took profit. We're out on the 14th at 90.53. So you can see here how detailed these are. So they said new XLE long trading at 85.70, daily cycle low, reversal breakout, et cetera, et cetera. Price target 187, target 290. Buy a diagonal 86, 87 and a half at around $1.25. Then I do another adjustment here. I won't go through all the details. Then we did adjustment to a free trade here. So here it says adjusting. It says if you're long the trade, make sure to take some profit and then adjusting balance to a free condor trade. And then I go through how to do that. And then here was the profit take on the 14th, trade around 91.02 if long the adjusted trade, currently up $200 per spread on zero risk. Yeah, I've tried. I can't program the trades for interactive brokers. I've tried. I can't. My coder couldn't do interactive brokers. So yeah, I would like to, but can't. And yeah, I have Ninja Trader, and yeah, I don't do MetaStock. So Thinkorswim, TradeStation, eSignal, TradingView, and then Wealth Charts. So pretty much cover. I would like to have interactive brokers, but I just couldn't get it coded for when I've tried. So here was the XLE trade. Got in here and then adjusted it. I won't go through too much here detail, but this was a great trade. You can see this is what we call a cycle low reversal type trade setup, and these are kind of the trades that we look for. So we're entered right here. You can see that it's starting to turn up. See it starting to bottom. Momentum starting to cycle up. Reversal here. So you're going to get this indicator, and then you can see the 4 hour. All the momentum was positive. So then jumped into the trade right there, did an adjustment, and it ended up adjusting this to a free trade. Okay, so let's go through real quick here. So we got into that. So here was the entry on the 31st, trade at 85.70. Then on the second, adjusted it to, adjusted the strikes a little bit. It was traded at 86.70, and then had some profit take on the third. It was traded at 87.56. So the spread had gone from $1.01 to 186, so we're up $85 a spread on the Condor, 84%, and then had the adjustment. So then did another adjustment on the 10th into the free trade. And so this is what I'll be showing you how to do and what to look for in the course this coming weekend. But so we took that calendar diagonal and then adjusted this to the free trade by doing a couple of different things. So we ended up with long the 87 call, short the 90. Okay, so we ended up long here, the 87 short the 90, and then sold the 91 call, bought the 94. Doing all that, we were able to recoup all of our costs in the trade, and so we had the trade on for actually a $3 credit. Okay, so if it went up, went down, we're still going to make $3. So the spread though widened out. Look at it, went from 0 to 189, so we're up $189 plus 3. So this was up $192 per spread on zero risk. Now we didn't make the max because we took it off before the expiration. So if we stayed in this trade, it would have made even more. I didn't think it was going to go up anymore. Plus we were at our short strike, so I went in and closed it out. So we were at our short strike and it kept going up. Now here's another one that we did. This was on NVIDIA. And I won't go through all the details, but these are very detailed. I'll just show you the kind of start with it. It says new NVIDIA long, trade at 136.90, daily cycle low, reversal off 150, 4 hour positive momentum. Here's target 1, 140, target 2, 143, did a diagonal. So adjustments, profit take. So got into this trade at 136.90, had an adjustment on the 23rd. It was traded at 142.70, and then had profit take on the 24th. It was traded at 141.80. This was up 164% return. So that was, these are very detailed. And so got into the trade right there, had a couple adjustments, ripped to the upside. So here was the trade right here. It was going out, went from 413, the spread, to 553. So this is up $140 per spread or 34% return. All right, so that is the one that we did there. Now here's some butterfly along condors. These are the other types that might be sent out. And so these are the kind of the updated summary here. So we started this back in 2019. And so through Friday, yesterday, we've had 200 trades closed out, 142 winners, 14 break even, 44 losers, 78% win right now. These are huge. These can be anywhere from 2 to 1 up to 25 to 1 and very low risk. Very, on average, maybe you lose 70, 75 bucks. Very, very low risk trades, butterflies and condors. So here's one that we did not too long ago on Apple, long call condor. And so you can see here, I'll just go through the initial trade setup. It says new Apple long trade at 228.80, holding support at the daily 50, simple moving average, positive momentum, upside target 1, 232, target 2, 234 by the condor. Here's an update there, profit take, on that, very detailed. And then here's the trade setup, got it right there. So you can see the indicators here. We had a cycle reversal. You'll get this tool right here. Then we had positive momentum. So took the trade right there. It's breaking back above that 50. Beautiful move to the upside, got out there. And so did this with the long call condor. So here's what you're going to learn next Saturday. So 230, 232.5 debit spread, then added the credit spread. All right, so total risk 82 cents or 82 bucks. $2.50 wide spread, total risk 82, potential to make 168 or 204% return. Okay, so that's the potential, and this one I think went out right there. So this made the max return of $167 per spread or 203% return. And then here's one that we did on Russell 2000. This is a short trade, and you can see it was trading right here. We're looking for a real quick short trade to the downside. So did this with a put condor, and so ended up with this making $140 per spread on that risk of 34. So $140 or 411% return, kind of in a one-day period. Telegram is great. There's no cost to Telegram. Yeah, it is fantastic service. You just boom, as soon as I click send, it goes out within seconds. It's a free app, so it's really good. It's really cool. And then these are fun. These are some other trades that you'll get when the right one comes up. These are what I call my lotto ticket butterfly trades. So here's a couple that were sent out. This was a Tesla butterfly pinning trade that was sent out as an alert. And so these are called binary trades. So you either win or you lose, but these are small risk trades. So this was new Tesla long binary monthly butterfly. It was trading around 189.30. Trade set up for potential monthly expiration pin at 200 next Friday. So buy this kind of butterfly for 12 cents, $12. That was the risk, okay? So it's trading at 189.35. We were targeting 200 based on a lot of different things I'll look at. And this one ended up making over 1,900% return. So then here it was on the 16th going out expiration. Trading at 200, butterfly spread at 215, up 1,791%. And here it was going out towards the expiration. It was up at 200, trading right there at our pin. So this was up $230 or 1,916% return. This was an unbelievable trade. So this is these are very selective. I mean, you don't get these very often, but this one turned out perfect. And so got into it right here, got out right there. And here was the trade setup. So this was done for 12 cents or $12. Right here, 12 cents. So you can see it's a 197.5, 200, 200, 202, butterfly, 12 bucks risk, $250 wide spread, potential 238, 1,983%. This one pinned. Now we'll scale out, but this is where it went out right at the end of the day. So it went out right there at the top, what we call that the top of the tent. It was right there, going out right at 200. So this was up, went from 250, the spread blew to from the $12 we got into it. So up 238, 1,983% return. on that. And then we had, here's another one that not too far back. This was GLD, a call butterfly as well. So this was another pinning trade. So again, what we call the binary, we were looking for this one to target up to 225, then we adjusted it to 230. So did this for like $25. But anyway, this is one that we did. It was trading at 220, 285. And then got out, it was trading at our target of 230. So this was up 203, 700% return on this pinning butterfly. All right, so here's the trade set up right here, get into it. And then we got out right there. So this was up 700% return. So this one we targeted 230 based on a couple different things. So 227 at 230, 233 butterfly. Our cost $29. Spread with 300 less 29, potential make 271. That'd be a 934% return. Didn't get it perfect, but got close to this one. So this was up right there, took it off. It was trading at 230.47. This was up $203 per spread or 700% return. So you can see that spread blew from 29 bucks to 232. So this was also pretty good one. Here's one we did just recently. So some are huge, some are not so huge, but this was still shows you how low the risk was. This is one we did last week on Microsoft. This was a put butterfly pin. So just to show you here again how great these can be, but you know, this one didn't make that much, but it made $64. But on the risk, our risk was 35, so still 182% return. So this one was a short put butterfly, a binary butterfly. We were targeting this one 410. All right, so set this up for around 35 bucks, 35 cents. And then on the 14th, took this off. You know, we had a really whippy week last week, right? So got out of this one before the market started ripping to the upside. And so set this up right here on the 7th, and then took it off right there, you know, right the day before the market's ripped. Got out of it because of the CPI number coming up. But here was the trade set up. So this was another penny trade. So we're targeting 410. So did the 415, 410, 405 put butterfly, 35 cents, 35 bucks, spread with $500, right? So potential, if we nailed it to make 465, that would be a 1,028% return, but still super low risk. And we made, you know, no big deal, but made 64 bucks, which is 182% return. So still nothing to turn your nose up on. So that's just kind of a summary of everything you will get. And then if you have any questions, let me know, and I'd be happy to answer any other questions that anybody has here today. All right.